So good afternoon, everyone. My name is Todd Jones. I'm the Director of Investments for Gratus Capital. It's nice to be with you again after a little bit of a break. And I hope everyone had a nice 4th of July holiday. I know we certainly did with my family. Great weather and all that. So I wanted to welcome you to the next edition of our Market Matters series on today, July 14th. We'll run through a quick agenda, and as in previous Market Matters sessions, what we'll do is we'll go back to talking about some of the COVID-19 updates that we're seeing right now. We'll also take a look at the investment and economic updates that have come out since our last update that we did 2 weeks ago. And then finally, we're happy to be able to share with you another great guest speaker. His name is Steve Barton. He's a Senior Vice President with C.B. Richard Ellis. It's a commercial real estate firm nationally. And he's got some great insights and some great content he's going to cover on the back end of today's presentation. Additionally, we're going to go in a little bit longer for this particular segment. We're going to go probably 15 minutes on the front end for the first 2 bullet points and leave about 20 minutes on the back end here for Steve and myself to do a little bit of a fireside chat. So we hope you guys came with some questions, particularly around commercial real estate. I know it's a really important area for a lot of people, and we look forward to providing you with some of the updates and insights that Steve has on that end. So with that, let's get started. Turning to the COVID-19 updates, and as you may be following in the news, it's not a great picture, particularly in the U.S. As I mentioned here, the U.S. is clearly the outlier, I think, responsible for a vast majority of the new COVID-19 cases globally. And you can see what's happened globally over the last, call it 3 or 4 weeks. Cases have gone from a flatlining situation to what some people are referring to as the second wave, if you will, that we've always thought was a possibility. It's just happening a little bit sooner than we expected. And you can see down here, Bloomberg does a nice job of breaking out country by country comparisons. You can see U.S. response here has gone from a declining trend to a pretty rapidly increasing trend. About 60,000 cases today, Florida being the epicenter right now in the U.S. with about 15 to 16,000 new cases of COVID per day. And this is a bit troubling, obviously, because not only is it new cases, but it's also new increasing numbers of hospitalization, and also increasing numbers of more mortality rates across every cohort of age, primarily, of course, related to the older generations, but still, nonetheless, something we need to be keeping an eye on. Of course, that doesn't seem to be impacting what's going on with the markets right now. That's something we'll touch on in just a moment, nor does it seem to be having a huge impact quite yet on the economy, although, because the economy, of course, is set to take a pretty massive hit in the second quarter. Those economic numbers have yet to be tabulated, but it's looking like it's going to be something like 9 percentage points or so off of GDP just for that one quarter, not annualized, but in just a single 90-day period. And that would represent, of course, the largest hit to the economy ever, to go back even from the GFC, even back before the 1929 crash back in the 20s, and roaring 20s. So certainly a unprecedented time for the economy, but the good news is that it appears the markets are dealing with it in a way that we more or less expected to some degree, not fully, but to some degree. So let's turn to the economic and investment updates. You can see we've done a couple of things here recently, and it's not anything dramatic. A few weeks ago, we did reduce our rating on U.S. large cap companies from a more attractive posture to a neutral. But we did, and that was really based on valuation, and we'll touch on why in just a moment. But interestingly, what we did and what we've been noticing over the last, call it 2 months, is that the U.S. dollar has been not increasing versus its trading partners, but it's been actually flatlining and even going down versus trading partners. So against things like the currencies like the yen, or the euro or emerging market currencies for that matter, the dollar has been declining, which is exactly what the president and most of the government would love to see, the Treasury would love to see right now, because a strong dollar has a way of crimping U.S. exports, and we don't need any more headwinds from a trade perspective. So the fact that the dollar is actually now moving lower is one of our triggers or catalysts to revisit international companies, broadly speaking. Emerging markets kind of at a neutral weighting, developed markets not a bit more of an attractive weighting, and some of that it will start to likely make its way into our portfolio over time. But again, recall, we've had a underweight to emerging markets and developed international markets for quite some time, since about 2011, and that underweight has served us very well from that perspective. So let's take a look at just some general comments here I thought I'd be making. Still, the headline is we're still actively managing risks, because I think with the market now having recovered almost all the way back to where it started the year, I think with today's move, we're going to be at a +1 on the S&P 500 for the year, which is staggering to think we've come this far, this fast in a very short period of time. But generally speaking, now that we've recall back in March, we had been building up what we call dry powder, or a cash position from basically middle of last year till February. We sold that entire position to buy stocks in March to really fill it back up, the equity bucket in March. That turned out to be a pretty well-timed activity. But now that valuations are on the higher side and markets have recovered, we're starting to raise cash through this what we call an ultra short-term bond ETF. So not in like a money market fund. Money market funds aren't paying you anything right now, maybe 5 basis points or so. Ultra short-term bond ETFs, in our view, are a really appropriate investment for cash right now, because they're earning you well above 1.5%, sometimes close to 2%, for what we believe to be a very low risk profile. Market volatility, I did want to point out, and I think I mentioned this in the past, is here to stay, and that really to us represents opportunity for the patient investor. And I think some examples of that have been seen recently and with other well-known investors. Some of you may have seen recently that Warren Buffett's Berkshire Hathaway made the largest acquisition, a $10 billion acquisition in the energy space, of all things, buying assets from Dominion Energy and Duke Energy that were running into some regulatory hurdles and regulatory issues. And this was the largest transaction that Buffett has done since they bought Precision Castparts about 5 years ago or 4 years ago or so. So, when other investors are starting to deploy capital and good opportunities, I think it just is emblematic of what we also think we should be doing at the moment. On the equity side, we just started this week, started the earnings season for Q2. So a number of companies are now starting to report their earnings on a daily basis. Today, we're Wells Fargo, JP Morgan, Citigroup. The day before, on Monday, was PepsiCo. By and large, those reports have been pretty good. So the bar isn't too high, but it just indicates that, and we've always thought this, Q2 and Q3 earnings will be pivotal for how stocks will react for the next 12 to 18 months, because we'll have a good vision of how COVID has been impacting their earnings profile. Because earnings, of course, are really what drives stock prices. The dollar, again, is falling, and that's key for us in considering adding international exposure on the equity side. Fixed income continues to be a bit of a tricky situation, because the Federal Reserve is getting active, or has mentioned that they will be getting very active in the fixed income markets. They've even thrown out terms like yield curve control, where they basically say the 10-year bond yield will never get above, call it 50 basis points or something, for the next 5 years, which is something that the Bank of Japan has already done with their 10-year bond. And we think that's likely coming in the foreseeable future. We've also been increasing the higher quality portion of our bond portfolio just to provide the offset to the high valuation potential on the equity side. And then on the alternative side, this is an area of the portfolio we think will just get more important as time goes on and as interest rates continue to move lower. So as I mentioned in previous calls, we are raising capital right now for some private market opportunities. And we continue to look to the alternative segment of our portfolios for income generation. Now that high quality bonds have seen their yields drift lower, we're continuing to look at our alternative section to generate income that's not necessarily dependent on the stock or the bond market. And just a brief note here that I thought was interesting to point out, because despite what's going on with the COVID situation, for those of you in Atlanta or DC area, or even some other high profile markets, Raleigh for that matter, may have noticed that property prices haven't really been impacted on the residential side by what's going on with COVID. And it's just really perplexing that hasn't been the case, but it kind of makes sense. So two things have happened. One is, it's not on this chart, is that interest rates and mortgage rates are now at, I think, all-time lows. On the 30-year mortgage, I've even been shown opportunities or offers to get a sub 3% 30-year mortgage, jumbo, by the way. That isn't unusual from my peer group and cohort that I've come in contact with. We also have, so that allows people to pay a little bit more for a home. The other thing you have here is this inventory issue, which I really had no idea was so constrained right now. You can see the inventory or number of active listings according to Realtor.com over the last 4 years. And you can see they've all started at this 1.25 or 1.2 million number of listings level to decline off, as the summer selling season tapers off. But look what's happened here recently in 2020. You have well below that 1.1 million mark, and now we're below nationally 1 million active listings on according to Realtor.com. That's something that is a huge supply constraint, which would just put a bid under prices. And again, I go back to the anecdotal evidence of Atlanta in some degree, but days on the market has been going down pretty consistently over the last 6 months. Let's turn to the equity markets real quick. As you can see on the screen here, this is a year-to-date chart through this past Friday. So it does encapsulate the first week of July. And this is what I was talking about. Large cap stocks is represented by this red line here. S&P 500 have really recovered to their post or pre-crisis levels. Beginning of the year, not pre-crisis high, but the January 1 level. We're just about there, probably be through that. Interestingly to note, and this is what I was talking about, giving us some more idea around the international, is that emerging markets have caught up quite a bit to the U.S. companies. Recall back at one point, they were trading at about a 14% or so discount to where the S&P was on a performance standpoint back in April, May, and the early part of June. Well, that discount has narrowed considerably to only a couple of percentage points. And that's how fast things can change. A lot of this has to do here with the fact that the dollar went lower versus EM currencies over the last few weeks. Developed International has kind of treaded water here recently, but caught back up a decent amount. But interestingly, what hasn't caught up, as I was talking to a client about this morning, is small companies. Small companies can't seem to find a bid in this market right now. It's really one of those areas of the market that's being left behind, if you will. A lot of that has to do with inability to procure attractive financing rates, but also investor preference for diversified business lines, global reach, things of that nature. So small cap is interesting. They still trade at a fairly elevated valuation, so they're not necessarily falling onto our radar yet from an attractiveness standpoint. But if this continues, this discount continues and earnings continue to recover, this might be something that we'll take a look at in the future. As I mentioned, this is a snapshot of this week's key earnings reports that are coming out. Today, again, JP Morgan, Wells Fargo, by the way, telling two very different stories. Wells continuing to suffer from client outflows and flight due to their issues. JP Morgan continuing to gain market share because they're doing right by clients. Tomorrow, we've got a bellwether in the healthcare sector, United Health. And then the other ones we'll be watching for, again, in the healthcare sector, would also be J&J on Thursday, Abbott Labs, both of which are portfolio companies for us in our dividend strategy. And then also Netflix. Netflix is just one of these work from home companies that has only gotten stronger since the start of the year. I think it's up close to 90% or something like that, because more people are staying home and watching Netflix. But we'll be looking to see the types of reports and the quality of earnings that they're showing in their reports. Next, this is the fixed income picture, and you can see a lot of basically the same story we've been telling for the last few weeks, but it's just worth reiterating. Yields tend to grind lower, are grinding lower. So just to orient you here, the aggregate bond index is the red line here. This is a year-to-date performance picture, which is up about almost 6% for government bonds. Most of this has to do with the fact that interest rates are moving lower. The actual yield on the aggregate bond index is, call it 2.5%, so not very attractive, but it is what it is. The investment grade bond index is up now better than the government index, but recall it came off a very visceral sell-off in March. And all of this has to do with the fact that the Federal Reserve, said that they would be supporting the corporate bond market either directly, as in providing loans to companies directly, or buying their bonds off the secondary market, which was an interesting adaptation, or buying fixed income ETFs. So they've been using a lot of different tools to get this index to recover. What's interesting, though, is that in the fixed income markets in particular, the junk bond market in the green line here hasn't really done a whole lot for the last month and a half or so. And that's primarily because I think we're starting to see an uptick in defaults. So COVID is creating quite a bit of defaults on the lower end of the credit quality spectrum, marginal business spectrum. And I think this is just reflective of the fact that there's still quite a bit of fear out there that COVID is going to impact maybe smaller companies, but also some other companies that may be on the periphery. And of course, you have your super large companies that are heavily indebted, like AT&T, which just did a really big acquisition with Time Warner. That their bonds aren't trading very well either, because they're going to have to roll that debt at some point in the near future. So just some key takeaways before we get to Steve would be that, number one, we remain pretty cautious on the recent breakout. Most of this is all sentiment driven. There's no necessary or requisite recovery in earnings that is accompanying this. This is why I say, and bullet point number 3, Q2 will be really instrumental in the direction of the way forward from where we are here. Because to get much further up in valuation, you really have to have earnings come through, at least on the individual company level now. At the index level, that's a mixed picture, because there's going to be some offsets, which is why we still believe active management, avoiding sectors that are experiencing some difficulty right now because of the dynamics around COVID, is going to be critical to earning above average returns in the future. And I think you can see all that coming through right now with the performance of our equity portfolios, not only on the domestic side, which are all outperforming the benchmark by a pretty wide margin this year, but also the international side of our portfolio, which is outperforming the benchmark right now on average by about 5 or 6%. And then also, retesting the lows, I had mentioned this, still is a possibility, although it's getting less probable as we make more as more time goes on, as companies recover and get more creative with their bridging the gaps that they have in their earnings portfolio or their earnings right now, but we're still keeping that as a possibility. And then finally, we still think building up portfolio resilience right now is the right answer. So taking profits, placing some of those profits in a short-term cash equivalent, or ultra short-term bond fund to wait for better opportunities down the road, which, remember, there is an election coming up in the not too distant future that's likely to cause a great deal of volatility around and leading up into that time frame. Be ready to act on some of those opportunities will be critical to earning a return in the future. So with that, I'm going to turn it over here or turn to our special guest speaker, who we're really glad who could join us today. His name is Steve Barton. He is a senior vice president with CB Richard Ellis, or CBRE. He's got a long time in the industry, which is why we think his perspective on the commercial property markets right now is going to be really valuable and insightful to the discussion we're about to have. listed as one of the top 200 brokers among the C100 network, which is a nationwide company. He also sits on the board of the Mary Hall Freedom House, which is a nonprofit here in Atlanta. So with that, Steve, I'm going to turn to your first slide. And again, thanks for joining us today.
Great. Well, thanks for the opportunity, Todd. So in today's world, we can all look around and see what's happening. People are working from home. Rates are being impacted. So I thought it would be interesting if I can arm you with a little bit of insight to provide you with some market knowledge as to the why. And with the why, then you can look into the future. Keep in mind things that are happening very fast. So what I say today may be irrelevant in a few days from now. The two things that everybody's wanting to talk about when I have conversations with them, and that is, will people go back to working in office buildings once a vaccine has been found? And two, what's going on with rates? This is a chart of the growth of people not working in the office, staggering 79% growth since 2004. Now, people have been working from home before 2004, but this is just when CB started tracking it. So the things that I want to point out are, in 2017, about 5% of the US workforce population was working from somewhere other than the office. And per CoStar, in Atlanta, they said before people were sheltering in place, it was 8.1% of workers spent 1 to 5 days telecommuting. So this sort of begs the question, if this has been going on for years and we've had the technology, and I say that because if you look at in 2007, that's when the first iPhone came out, and you can kind of see the little bump right there. So it begs the question, if we've had the technology, why haven't people been working away from the office more? One, flexible work location is not a new concept. It really started with the millennials, and their concept, as we're probably well aware of, was, if you're going to make me work hard, then I want some flexibility. The other thing I want to point out with this chart is that with the pandemic going on, whether we find a vaccine tomorrow or in a few months from now, it's going to accelerate people working from home. And the third thing that's most important is that I'm having two sets of conversations with my clients, and that is, what are we doing now, or what should I be doing now, and how do I incorporate the now with once a vaccine has been found? Because when people are leasing office space, it's typically a 5 to 15-year commitment. If you recall on the first slide, we started tracking in 2004 the flexible workplace. But what I want to point out is what was the engine behind it. So if you look at this slide on our left side, that's kind of showing the end of the baby boomers. And then in 2001, you start seeing the millennials come into play. And the thing that's of most important that I want to draw to your attention is if you look at the anemic growth starting in 2001, and even in 2016, there's not a monster change in the amount of growth of employees. So the reason that this is so important is because it's the supply side is tight. And again, it's going back to the comment that is, if you're going to make me work hard, then I'm going to have a little say in where I want to work. If you'll kind of look at the trend that CBRE has forecasted, is that this is just going to continue, meaning there is not going to be a lot of new employees coming into the market. So employers are constantly going to have to work around what their demands are. So the reason I want to show these first two slides is that this is the information that everyone is using to justify the demise of the office. However, there are items pushing back and working from home that I kind of want to bring to your attention. So one, if you can imagine you're the top of your class, you're about to graduate from college, and you got a job offer. And one offer was to go work for a company where you could work from home, and you may have 1, 2, or 3 roommates. Or the other job offer, which may even be less money, but it's to go to an office. And at this office, you're going to have the ability to collaborate with others, be around other people your age, be around your boss to try and figure out a way to get ahead, and find someone to help kind of push your agenda. The second thing that's going on is, from the exact opposite, is from the employer perspective, is how are you going to onboard and train and mentor this really expensive new employee. The other thing to think about is if you are slightly older and you're working your way up the corporate ladder and somebody asks you to start working from home, right or wrong, the first thing that's probably going through your head is, are they trying to tell me something? Should I be looking for another job? So now to add sort of an outside factor in that, and I'm going to call that the wellness, and that seems to be the topic of conversation on a lot of asset managers' minds. And what I mean by wellness, and that is, how is a building not only clean from the janitorial perspective, but from an HVAC perspective. So if you can think from a perspective of, do I need to touch the sink to wash my hands? So we're already starting to see that. The same thing with a toilet. So now with technology, that's going to be even bigger, from a door opening without me touching it, an elevator being used by my foot and not my hand, as well as lights being turned on and off. So from the wellness perspective, in the past, if people weren't working in the office, maybe they were or were not working from home, but they surely were working at a Starbucks. So now that people are concerned about wellness, you may not see that big demand for people wanting to go into Starbucks, and they're going to probably want to go back into the office because they know the wellness guidelines that are in place. And then the last comment is I want to, if I can take daycare out of this comment, most of my clients are saying that their employees are very productive right now, even more so than they were in the office. But that same CEO is asking the question, is that because they're working from home and there's no commute, or are they afraid of being furloughed? Or is it they've got nothing else to do? So to answer the first question, the way that I like to say it is, people have been telling me the great experiment of working from home proves that we don't need office space. But I think to myself, no, it's the great experiment that we now have the technology so that people don't have to work from the office space and they can work from home. So if I've not already answered it already, I do not see the demise of office space, but I do see it changing much more rapidly than it has in the past, which comes to mind that picking the right building, picking the right landlord, picking the right layout of your space, and picking the right amenities with your building are becoming even more important. So the number 2 question that I'm being asked is, where are rates going? So before I answer that question, I'm sure we all remember that Econ 101 class we had to take in college, where they always say price was based on supply and demand. But in the real estate world, it goes a little bit bigger than that. It's supply, demand, the length of the lease, the TI, which is tenant improvement allowance, credit of the tenant, and the one thing that most people really don't think about, and that is the lender. So if you change one item, it's going to affect all the others. And keep in mind, the lender is above all that. So if you go to slide 3.
Sure.
So the one thing that I want to point out, which is really interesting, is that if you see the thin blue line, you're going to just continue seeing that increasing. That is the renewals that are going on in the market. And if you see the bar, the big green bar on the far right-hand side, that's the number of transactions that are going on. So what this slide is telling me is that most people are doing renewals, or they're just kicking the can down the road by doing nothing. So here's the interesting thing. If a company's wanting to do a renewal, mostly what I'm seeing today are people are doing short-term renewals. And short-term renewals come at a price, meaning they're more expensive. And if you're not doing anything right now and you're just sort of hunkering in place and just kind of waiting, which tells me that there's going to be a pent-up demand. So if you look at the green line, it is 58% below the typical average of what it was the year before. So,
hey,
what
Steve, can I ask a quick question?
Sure.
Quick question here?
Yeah.
So I think it might be helpful for the audience. I apologize, I didn't do this at the beginning. Would you mind just reviewing a quick short list of some of the organizations and tenants that you represent? And then the second part of that would be, what are, maybe within your client base, what are some of the reasons people are renewing as opposed to signing new lease transactions?
Got it. So to answer your first question, I'll kind of just throw out a couple of clients that I've just done some recent work for that you may recognize. So I just finished up a big lease with Piedmont Healthcare, another lease with Morehouse School of Medicine, another company that's called In Community. They were formerly known as GCSS. And then we're doing work for a company called Positive Impact. And then the range and the tenant size has been 2,000 square feet to 40,000 square feet. That's been the largest transaction that I've done. Keep in mind, everything that I have worked on, Todd, that has closed so far this year are things that we started probably 8 to 12 months ago. So what you're seeing is transactions that are typically happening now have been being thought about for some time, or there was like a quick change in direction. So as an example, one of the clients that I recently did a transaction for was they actually shrunk their space. And that was because they were able to put people working from home. The conversation that we did have with them was, do I completely get rid of my space or do I just shrink it? And they shrank their space by about 50%.
Wow.
And that was just, and the reason that they, again, didn't do more, even though 100% of their employees can work from home, is that he was thinking of that same conversation that we kind of pointed out, is that, when I have a new employee, what do I do with them? I can't have them working from home. I need to somehow or another get some people back. And then the other companies that we've done work for is even though COVID was going on, they were anticipating what were things going to look like post-COVID. And so they had to do something. And again, we just kind of followed through with what their thought process was, 8 to 12 months ago.
Got it.
So going back to the slide, so what's happening is that, so you are seeing people push off and just do a renewal, and they're going to do a short-term renewal, which is keeping rates up, and then long-term, because we have pent-up demand, because people aren't doing anything, you're going to see pressure keeping rates up from that perspective. The other thing that's affecting rates is tenant improvement allowance. So from 1950 to 2000, construction pricing doubled. And then from 2000 to 2020, it doubled again. So again, think about this. It took 50 years to double, and then here we've done it in 20 years. So what does that mean? It's getting more expensive to build out space. So the deals that are getting done, companies are wanting to preserve their capital. So if they have to do any type of renovations with construction pricing up and they're wanting to preserve their capital, you're seeing companies be more open to paying higher rates than wanting to pay for renovations. So you see those two things pushing, that are constantly pushing the bottom to kind of rates up high. If you go to the third slide.
There you go.
Thank you. So what's so interesting about this slide that nobody really ever tracks is what's going on from the perspective of the tenant and the amount of space. So, we have seen companies or individuals goes from large offices to smaller offices to cubes to smaller cubes to tables to now even working at Starbucks. So it's easy to see that we need less space. So that part's sort of obvious. But in this slide, what I want to show you is that there's a large gap starting in 2009 between the amount of space that people are leasing and job growth. And so from 2009 going all the way to 2019, that gap just keeps getting bigger. And what that is telling the market is that people are only leasing the amount of space that they need. And so why is that important? Is because now you're not going to see what we call a shadow space. So as a company needs to downsize, they don't have as much space that they want to downsize. So that's, again, keeping the market on a tighter than what maybe some people would be projecting for right now. Obviously, we're starting to see a lot of space hitting the market for sublease. But the issue that revolves around the sublease market is it comes with no tenant improvement allowance. It does come with some credit risk. So not everyone is wanting to jump on that option.
Steve, there's maybe a question that just came in off the queue along those lines is a question from Tony. Thanks, Tony. He said, wouldn't you guess, or do you know if people are extending the lease with no real longevity, meaning, agreeing to go month to month with only like a very short-term notice? I mean, do you think more and more companies are I guess, renewing with these very short-term leases? Is that kind of what, I think that's the nut of the question.
Yes. So if you the previous slide, if you just jump back,
Sure.
you'll see, well, you went forward, go the other way.
There we go.
There you go. So on the blue line, you're seeing the deals that are getting renewed. So there's more renewals that are happening, and the renewals are, as the question was asked, are for shorter terms. So
right. So there's no real longevity in those renewals. I
correct.
Guess. Okay. Yeah. Got it.
So what we're seeing is that people are typically kicking the can down the road by 2 to 3 years. I'm not seeing any month-to-month lease extensions, and I'm not seeing a 1 year, just because a 1 year happens so fast so we'll see it just a little bit longer.
Yep.
I think we just talked about this slide a little bit about the gap and that there's not as much shadow space. And then we're talking a little bit about the sublease market. So there is going to be a lot of space in the market that's for subleases, but it's got to be specific to the company wanting it. If they like the build out, again, that's because it just doesn't come with any type of tenant improvement allowance. And people are not wanting to, and again, people are not wanting to spend money to move into a space. I know there's a lot going on here, but I want to point out a couple things. So again, if you see the light green is what was being delivered, office buildings being delivered, and the dark green was absorption. So if you notice, like in 2010, there was a lack of buildings starting to be delivered to the market. And what does that mean? It just means that there's now a supply-demand problem. So their demand goes up, but there's not as much of the supply. And one of the things that I want to point out is that today, as you drive, if you're driving around Atlanta, you see a lot of cranes. It's probably across the United States. But most of the buildings are at least 50% pre-leased. Prior to that, like if you look in 2008, spec buildings or the new buildings coming out of the market were 16% pre-leased. So that thus impacts them significantly if we have a market decline. So what's interesting is, as asking rents went down, the thing that is of interest is if you look at from the trough to the peak, and on the far left, we have the S&L crisis, and in the middle, we have dot-com bust, and on the far right, we have the Great Recession. And what's interesting is the one on the far left and the far right were financial blips that happened to the market, and that from trough to peak was significantly longer, about twice as long as it was when the dot-com busted. So just sort of looking at the past, what's going on now will not be as long as some past recessions that we've had. So I say all that So we've got shorter term rates are more expensive. We've got construction pricing is high, and which again is pushing rates up. We don't have a ton of supply, as in the past because of all the pre-leasing. And so I say all that because I am not seeing rates declining at this current moment. And if you look at the past and use that as predictive future, then CBRE Atlanta a few weeks ago was projecting there to be about a 2.7 to 4.1% rent drop. And I know these are being revised, but regardless of the rent drop is more than the high, which is a 4.1, we don't see it being a long period of time. So those are some of the what I see happening in the market. So to kind of summarize, I do see flexible working space becoming more important, but it will not be the death of office space. And I am not seeing any drop in rates right now. So I don't know if there's other questions. I could talk about some other things that we're starting to see in the market.
One question that a client had asked, and I don't know what you've got from a representation standpoint outside the Atlanta area, but a few clients have been asking about, coastal, office space versus non-coastal. Do you have any thoughts or perspectives on that?
I do not. So I probably would not be a good person to ask, coastal versus non-coastal. However, I am seeing the conversation of urban versus suburban. So from that perspective, we're seeing a lot more conversations with companies wanting to do suburban office buildings versus urban, specific the two-story building, and you kind of ask why. And one is because they're controlling their space. Not only are they controlling their space, but they're potentially controlling their HVAC. As things kind of shake out on all this, not only do I see suburban doing better, but it will definitely be coming out of this much faster than everybody else.
There was one final question, and it does revolve around kind of upgrades to buildings. What kind of upgrades to buildings are you or your clients asking building owners to make if they are in fact looking to sign a new lease?
So what's so funny is that everybody's asking the question, but nobody really has an answer. But what I will tell you, not only from what we're asking, but what we're seeing is new developments, how they're pivoting a little bit. So on the new buildings, you're starting to see ability to add more outside air for HVAC. Right. Everybody wants to make sure there's air coming in. The other conversation is that everything is touchless. So that's between sinks to water fountains to doors to lights to elevators to everything. So those seem to be the more things that my clients are asking for, but on build out. But what's even more a topic of conversation is janitorial. Typically janitorial happens in an office building after hours. You assume your space is clean because your garbage can got empty, or maybe the trash on the floor got swept up. But what we're recommending is to have janitorial up front and center so that employees can see it getting clean, and that and that they feel comfortable that their company or their employer is taking care of them.
Well, I think that basically takes us to the time that we've got allotted for today. Steve, I definitely wanted to say a big thank you for your willingness to join us on the call today. I know this was, again, a topic that's close to a lot of people's hearts, particularly in Atlanta, but also some of our Florida clients as well. So, again, right person at the right time, and we thank you for coming on.
You're welcome. And if anyone has any questions, they are more than welcome to reach out to me. And whether they want to talk about other items, I'll hook them up with the appropriate person at CB.
Very good. Well, thanks again, everybody, for joining us on the call today on Market Matters. We look forward to seeing you all in 2 weeks for our next update, and be looking for that invite to come out here within the next week or two. We'll talk to you soon. Thanks a lot.